a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about derivative-backed income ETFs, which have seen a surge in popularity lately. So let me share my screen and talk about the explosion in this derivative-based ETFs. So what we have seen lately, that while still a lot of money is going to plain vanilla, low-cost ETFs, the new ETFs that are being launched, they are becoming more complex. Most new ETFs that are being launched are actively managed, and many use derivatives. And two recent regulatory changes, the ETF rule and the derivative rules, they made it easier for providers to A, launch ETFs, and B, back derivatives within ETFs. And that has led to a surge in these derivative-backed, derivative-based ETFs. So we can broadly classify these in three categories. So the first one is buffer or defined outcome ETFs. And I talked about them recently. They were quite popular this year. They are quite popular this year because of the roller coaster ride in stocks that we have seen. And as I explained in my earlier video when I talked about buffer ETFs, these are generally suitable for investors which are in retirement or close to retirement. Makes sense for those kind of investors, risk-averse investors. Then the second category is leverage or inverse ETFs. So these should be used as trading tools only. And we know that because of volatility decay, if you hold them for longer than a day or two, then the outcome may not be what you would expect normally. So these should be used only as trading tools for short term. And of course, there are single stock ETFs in this category, as well as ETFs that provide leverage or inverse exposure for a sector or a group of stocks. Then the third category is option-based income ETFs, and we are seeing so many launches in this category lately. Now, this category also, they are single stock ETFs, the kind of yield max ETFs that promise sky-high yields. I have talked about them. They underperform relative to their underlying securities, and still they are very popular. Maybe I'll do another video for that category in the coming weeks. Today, we are talking about option-based income ETFs that use a diversified portfolio of stocks, the kind of JEPI ETF. And this category is also becoming very popular lately. And let's see what these ETFs, how they work and what they aim to do. So basically, in simple words, when you use call options, and when stock or stocks, if it is a portfolio stocks, then options, they expire worthless and you get pocket the premium. If stocks go up, then the option is exercised and your gains are capped. So in general, these provide high income with some lower volatility to the portfolio, but you will see that they underperform over the longer term. We'll come back to devil's bargain in a bit. So they work best in sideways markets, but they underperform in strong bull markets. They may provide some protection when stocks fall. They had outperformed in 2022. JEPI had done quite well compared to the S&P 500 index, and that has led to massive inflows into these ETFs. JEPI became the largest actively managed ETF, but you will see that these have been underperforming their respective benchmarks since inception, and many have underperformed this year as well, which was not so good for stocks. Now, talking about devil's bargain, so this researcher, Ronnie Eslarov, he's currently he's a quant researcher for Citadel currently. So he did some extensive research into these options-based income ETFs, and he called these devil's bargain. And his research showed that using options to generate income undermines investment returns. And in fact, you can look at his paper if you want. And he has used look at the performance of S&P 500 put buy right S&P 500 covered call strategy for about 25-year period. And he found that these strategies massively underperform the index. So now let's take a look at some of the we'll take a look at the four most popular ETFs in this category. So the most popular one is by JP Morgan Equity Premium Income ETF, ticker symbol JEPI. And this, as I mentioned, did very well in 2022 and has seen massive inflows, including $3.7 billion this year, $39 billion in assets, and this is now the largest actively managed ETF. So this tends to create a diversified, low volatility portfolio of about 130 stocks, and then uses S&P 500 index call options to generate income. This is reasonably priced at 35 basis points compared to some newer ones, especially the single stock ones, which are 1% or more, which charge 1% or more in fee. So let's take a look at this ETF by going to the quote page on Zacks.com. You can read our research report and read our articles, and using the link, you can go to JP Morgan webpage for this ETF. And as I mentioned, this uses bottoms-up fundamental research to select those about 130 stocks and then the covered call overlay to generate income. So 12-month rolling dividend yield of 7.34%, 35 basis points. If you look at the portfolio, you will see that Visa, MasterCard, Progressive, these are the top holdings currently in this ETF. Now, the second ETF that I will highlight that also uses S&P 500 index as its benchmark. And this has actually performed better than JEPI. And it's also older, but not as popular, still quite popular with 4.3 billion in assets. Hasn't seen so much interest this year either compared to JEPI. This holds high quality, dividend-oriented stocks and then writes covered calls on those individual stocks. A slightly different strategy. And this is slightly more expensive, 56 basis points in expense ratio. And again, you can use the link on Zacks.com quote page. So this is Amplify dividend stocks, covered calls on those individual stocks. You can look at the portfolio, what it holds currently. So these are the top holdings: Caterpillar, Microsoft, American Express, Visa, and Goldman Sachs. You can look at the selection methodology, sector allocation, etc. So slightly different methodology as well as slightly different exposure compared to JEPI. Now, the third ETF which I'm highlighting is again by JP Morgan, and this has lately become quite popular. So this uses the benchmark Nasdaq 100 and Nasdaq 100 as the benchmark. The ticker symbol is JEPQ. And this has a diversified portfolio of about 100 stocks. And these 100 stocks are pretty much similar to the Nasdaq 100 stocks. And then it uses Nasdaq 100 index call options to generate income. This has about 25 billion in assets, very popular, and this has seen even more cash inflow this year, even more than JEPI, 6 billion this year. So let's take a look at this ETF. And if you look at the portfolio, so about 108 holdings currently, and the exposure will be quite similar to the Nasdaq 100 index, with Microsoft, Apple, Nvidia, and Amazon as the top holding in the portfolio. The Nasdaq, the 30-day SEC yield is 15.6% currently, and expense ratio is the same as is down for the year, as you see here. So investors love this yield, and they miss that these ETFs actually underperform. So this also uses Nasdaq 100 as its benchmark. It's by Global X. The ticker symbol is QYLD. This holds stocks in the Nasdaq 100 index and uses Nasdaq 100 call options to generate income. Slightly more expensive, 60 basis points, quite popular, but not as popular as JEPQ. And again, you can go to the website using the link on Zacks.com to learn more about this ETF. And if you look at the holdings, basically, Nasdaq 100 index holdings, and then uses call options on the index. And then on the next slide, I have the comparative performance. So I have, this shows the comparative performance of JEPI and DEVO versus the S&P 500 index. And I have taken the performance since JEPI's inception in May of 2020. And you will see that the S&P 500 index has surged 112%. DEVO is up about 89%. And JEPI is up about 74% since then, since its inception. So significant underperformance compared to the S&P 500 index. And this uses total return. So I am taking into account income and the ETF's price appreciation, both total return since inception. So this slide shows the year-to-date return of these two ETFs versus the S&P 500 index. So you will see, again, DEVO has done better. DEVO is up about 3% year-to-date. JEPI is up about 1%. And S&P 500 index, despite all those gyrations, it's now almost flat for the year. On the next slide, I have the comparative performance versus the Nasdaq 100 QQQ and the comparative performance of JEPQ and the Global X product QYLD. And again, this is since JEPQ's inception in May of 2022. And you will see that during this period, the QQQ, the Nasdaq 100 index, is up about 57%, and these two ETFs have again underperformed. JEPQ has done better. That is up about 43%, whereas QYLD has seen a massive underperformance, up about 17%. Then let's take a look at the year-to-date performance. And year-to-date, the Nasdaq 100 index is actually almost flat, again, after a lot of gyrations. And both these ETFs have underperformed. JEPQ is down about 6%, and QYLD is down about, JEPQ is down about 4%, and QYLD is down about 6% year to date. Thanks for watching. Make sure to check out Zacks.com/promo for an interesting offer. Make sure to subscribe to our YouTube video channel so that you do not miss anything. And I'll see you next week.